Hi, it's Michael Farr from Farr, Miller and Washington. Here in early April on a lovely spring day in Washington, D.C. Welcome back to our market calls and market commentary. We've sent out today our quarterly newsletter, or at least an excerpt of it. I hope you enjoy it. If you'd like to receive the whole newsletter, we're happy to send it to you. Send Helen Berthoff an email, and that's all in the information out today, and she'll send you the full copy of the newsletter free of charge. Markets continue to hold up really nicely. We've been looking for a pullback for so long, it's becoming hackneyed, I think, to suggest that we're overdue for one. It has been a pullback called for by most and seen by none, and markets continue to hold in. I worry about the complacency that I'm sensing from investors that markets may just never go down again. I assure you that markets will go down again, but it doesn't look like it today. The Dow is 20,650 or thereabouts. The 10-year Treasury has rallied this week. With the missile launch into Syria, we saw a flight to safety. Treasury bond prices went up, and therefore the yields fell. The 10-year U.S. Treasury note is now yielding 2.31%. The euro versus dollar is pretty stable, 106 versus the euro. It's still a good time to take a vacation and enjoy those more expensive restaurants in Europe. Oil has gone up a great deal, $53.20. So, what does it mean, and what else are we seeing? The television people have been kind in inviting me on more. I will be on the nightly business report on PBS tonight. I have a monthly spot with those very kind people. I'm going to talk about markets being fully valued. At 19 times earnings, I do not think the S&P is inexpensive. I think there has been, if you've been reading our market commentary, there has been a certain amount of sector rotation that we've been experiencing. Things that have actually, different sectors that have actually come down 10%, and on sort of a rolling basis. I think that energy and consumer staples have not participated in the current rally, and I think that they're probably areas for opportunistic investing. We own some names in those areas. There seems to be, I think, a new dawning in Washington of how negotiations may go. The Freedom Caucus seemed to certainly oppose the health care reform bill, which didn't appear to be a very good bill to start with. Many were hoping it would just be a starting point for discussions. But Freedom Caucus seemed to be blocking a lot of what President Trump would like to do, and President Trump has begun to reach across the aisle to Democrats to negotiate to get their votes to forward his agenda. It does seem ironic that the hard right, by opposing him, is sending him to Democrats with whom he's going to have to negotiate and come up with a more moderate outcome than if the hard right had dealt with him to start out with. It's just an observation. I don't know exactly what it means. But it does seem that we may have more moderate outcomes from Washington than originally expected. So as you look at markets, know that at some point this wonderful music that we've all been enjoying will stop. And it will be very important to have a seat when the music stops. You have to know what you own and why you own it. I tend to stay away from the really high PE speculative stocks, the things that have gone up and up and up and don't have much underneath them. I think that Tesla is a great example in my mind of a stock that is much more form than substance. They make a great automobile, but the legacy automobile makers are also coming out now with battery-powered cars that will do largely the same thing. Will they be as technologically flashy? I don't know. But The financial model for Tesla and the way that it's working right now doesn't make sense. An analyst at Piper Jaffray yesterday lowered his earnings estimates for 2017 and 2018 to the loss category. It was a huge loss for 2017. He'd been looking for something like an 11-cent a share profit, and I think the loss he was looking for 2017 was something over $4. A loss for 2018 as well of somewhere around 17 cents, something like that. What did he do? He raised his price target by 65% to $360 a share, something like that, from $220. I don't understand it. He suggested that investors would need to suspend their traditional valuation methods. What does that mean to me? That means don't pay any attention to the numbers and just buy the stock. Don't worry about the smoke coming out of that airplane engine. I'm sure your flight will be fine. Yeah, right. And Morgan Stanley yesterday came out with a strategy piece from their main strategist at Morgan Stanley suggesting that stock prices could rise another 30%. Now, indeed they may, but the argument was that at a late stage of a blow-off bull market rally, things went to excess in ways that didn't make any sense. I can't imagine advising an investor that they should buy something today because we're getting ready to enter a phase that doesn't make any sense. So, I say stick to your knitting, know what you own, be conservative. Your money was hard to make. It is also hard to keep. This is a very long-term race we are all running. Emotion is the foe of the long-term investor. Avoid it. If you need some help, if you need some advice navigating these turbulent waters, please give us a call at Farr, Miller and Washington. If you would like a copy of our newsletter, of our quarterly newsletter, you can also just send us an email at invest@farmiller.com. I hope you have a wonderful holiday here. It's Passover and Easter coming up. That you get that you get a break, that you get to enjoy the weather and have a little family time as we begin springtime, and it'll be over before you know it, and we'll be having messages about summer. But for now, enjoy. Thank you so much for tuning in and listening to me. In Washington, D.C., for Farr, Miller and Washington, I'm Michael Farr.